Faculty of Economics and Business, University of Indonesia, FEBUI, is a modern, dynamic, and welcoming campus, a place to study for the nation's future leaders. Situated in two strategic locations, Depok and Salemba, we are fully committed to contribute to the development of knowledge in economics and business, and to nurture future leaders with a sense of social responsibility and the ability to address global environmental changes. For over 65 years, we have produced the country's best graduates that will potentially play important roles both in the Indonesian government and the private sector.
So my name is Jae Bin Ahn, I'm from Belanda, and one of the many things I like about Fakultas Ekonomi and Bisnis Universitas Indonesia is that the campus is really green. It's wonderful.
In the future, we are aiming to become Asia's leading economics and business learning center, which contributes to the development of Indonesia and the global community. FEBUI has three departments: the Department of Economics, the Department of Management, and the Department of Accounting, with specified courses such as With more than 65 years of experience as a prestigious educational institution in Indonesia, we have become one of the few that consistently produce the best graduates in the country. The development of FEBUI is not only limited in the standard degree education, but also in non-degree education, research, and consulting. Through cooperation, we always strive to provide benefits for both parties involved.
Hi, I'm Narumi Ishikawa from Japan Chiba University. Thank you for FED to expanding my knowledge. Thank you for Bangsa Indonesia. Terima kasih banyak.
Currently, there are plenty of FEBUI graduates who occupy key positions both in the government and private companies, local and international. The Faculty of Economics and Business University of Indonesia welcomes the entire academic community with open arms to achieve a bright and successful future together.
Part of FEBUI.
Be part of FEBUI for a better future.
FEBUI, massive campus with great people and unique local food.
Good morning, Honorable Keynote Speaker, Professor Jae Bin Ahn, Professor of International Economics, Seoul National University, South Korea. Honorable Keynote Speaker, Professor Riza Kasidi, Associate Editor of Journal of Strategic Marketing and International Journal of Consumer Studies, Macquarie University, Australia. Dr. Doni Abdul Khalid, Head of Department of Management, Faculty of Economics and Business, Universitas Indonesia, and of course to all of our distinguished participants. On behalf of Department of Management, Faculty of Economics and Business, Universitas Indonesia, we would like to extend a very warm welcome to all of you to the opening ceremony of the International Conference on Business and Management Research, ICBMR 2020, Leveraging Business and Management Knowledge in Digital Era. Ladies and gentlemen, before we begin, please rise for the national anthem, Indonesia Raya. Thank you. You may be seated. ICBMR 2020, Leveraging Business and Management Knowledge in Digital Era is brought to you by Bank Sentral Asia, Bank Rakyat Indonesia, and Telin by Telkom Indonesia. And now we kindly invite Dr. Rifeli Dewi Astuti, Organizing Committee ICBMR 2020, to present the committee report.
Okay, good morning, everyone. Good morning, everyone. Distinguished keynote speakers, scholars, and all the presenters. We are honored and delighted to welcome all of you for attending the 13th International Conference on Business and Management Research 2020. This year, ICBMR theme is Leveraging Business and Management Knowledge in Digital Era. As we know that digital era is closely related to automation and data exchange, replaces traditional work by providing smarter tools. So in this digital era, will not only reduce human resources, but also bring many benefits, including increased productivity, efficiency, quality, accuracy, reduce human error, information, and data flow management. However, due to the condition of the COVID-19 pandemic. So this year event, will have differently by doing virtually. In this 2 days conference, we have 107 papers presentation from 5 countries that will be present in parallel sessions in the field of finance and banking, including Islamic finance and banking, marketing, human resource, general management, operation management, and economics. All presented papers will be published in the conference proceedings or in our supporting journals. This year, we have a new activity, namely Meet the Editors. So in this session, the selected participants have the opportunity to present and get feedback from reputable international journal editors. This large gathering of academicians would not be possible without the support from our partners, PT Bank Sentral Asia, PT Bank Rakyat Indonesia, and talent by PT Telekomunikasi Indonesia, and also all the supporting journals and partners. Last but not least, we would like to express our gratitude to all the contributors, presenters, track chairs, reviewers, keynote speakers, and members of the organizing and scientific committees for their hard work and contribution. We are looking forward to an intellectually stimulating conference, thoughtful discussions, and an engaging experience with fellow attendants virtually. Thank you so much and have pleasant days. Thank you.
Thank you very much, Dr. Riveli Dewi Astuti, the organizing committee of ICBMR 2020 for the committee report. Ladies and gentlemen, we would like to proudly present you the ICBMR journey video.
ICBMR is organized by Management Research Center, Department of Management, Faculty of Economics and Business, Universitas Indonesia, that aims to provide an excellent international platform for the academicians, researchers, and budding students around the world to share their research findings and to find international linkage for future collaborations in the areas of business, management, and economics. Previously, ICBMR had been held in Jakarta, Manila, Ho Chi Minh, Seoul, Kyoto, Lombok, Padang, and last year in Bali. This year, ICBMR is held as a virtual conference where there will be online presentations, meet the editors, doctoral colloquium, and webinar keynote speeches. The theme for the 13th ICBMR is leveraging business and management knowledge in digital era. The first keynote speaker is Professor Jae Bin Ahn from the Graduate School of International Studies, Seoul National University, will give a speech about financial technology in emerging countries. The second speaker, Professor Riza Cassidy, Associate Editor for Journal of Strategic Marketing, an international journal of consumer studies from Macquarie University, would give a speech about marketing in digital era. On the last day, Professor Ian Fa, Editor-in-Chief of Asia Pacific Journal of Marketing and Logistics from Curtin University, will discuss how to publish an article in a reputable journal. All accepted full papers will be published in the conference proceedings with ISBN and proposed to be indexed by Thomson Reuters Conference Proceedings Citation Index. The supporting journals for ICBMR 2020 are Indonesian Capital Market Review, ASEAN Marketing Journal, and the Southeast Asian Journal of Management. Selected outstanding papers will be invited for fast-track review and publication in the International Journal of Business and Society and International Journal of Economics and Management. Our special thanks to our sponsors Bank Central Asia, Bank Rakyat Indonesia, and Talent by Telkom Indonesia.
To begin our event, we kindly invite Dr. Teguh Dartanto, Vice Dean for Academic Affairs, Faculty of Economics and Business, Universitas Indonesia, to give welcoming speech.
Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi, salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan bagi kita semua. A very good morning, distinguished speaker, ladies and gentlemen. On behalf of the Faculty of Economic and Business, Universitas Indonesia, it is a great pleasure to welcome all of you to the 13th International Conference on Business and Management Research 2020. This conference is organized by Management Research Center, Department of Management, Faculty of Economic and Business, Universitas Indonesia. This event is conducted to provide an international platform for the academician, researcher, and student to share their research findings and to find international linkage for future collaboration. As one of the leading business schools in Indonesia, Faculty of Economic and Business, Universitas Indonesia, has always encouraged its academicians to improve their contribution in the economics and business field to support various organizations in Indonesia. With such contribution, these organizations are expected to create sustainable innovation to support the economic growth, especially in the current situation, where change occurs in the world's order caused by disruption of the digital technology and the COVID-19 pandemic. The COVID-19 has changed our life, our human activities, and that has forced us to be more adaptive, agile, and flexible in the responding the situation. I believe that all of the ICBMR participants are agile and optimistic people who see every change as an opportunity for the progress. Finally, I would like to express our sincere gratitude and appreciation to the leader of Universitas Indonesia, our keynote speaker, Dr. Jae Bin Ahn, Professor Rija Chashidi, and Professor Ian Pao for their tremendous contribution and support. Our gratitude is also to the scientific and organizing committee for their hard work to make these events possible. Even though this year ICBMR is held virtually, I hope this event will still provide various insight in the field of the business and management and beneficial for all the participants. May you have a wonderful experience in sharing your knowledge and enjoying the conference. Good luck.
Thank you very much, Dr. Teguh Dartanto, for the welcoming speech. Moving on to our next agenda, we are going to have two keynote speech sessions today, one in the morning, continued with the afternoon session. Before we continue, allow me to announce the session rules. Participants can fill in the list of attendance form provided in the Zoom chat room. Participants can ask questions via Q&A room by mentioning their full name, institution, and question. And moderator will select and read questions from participants. Ladies and gentlemen, all of our conference sessions recording can be accessed through MRCFEBUI YouTube channel. Do not forget to subscribe and like our channel. And this morning, we are very honored to have Professor Jae Bin Ahn, Professor of International Economics, Seoul National University, South Korea, as our keynote speaker. Good morning, Professor Jae Bin Ahn.
Good morning.
Without further ado, ladies and gentlemen, please welcome Professor Jae Bin Ahn.
Thank you very much. And now I'm trying to share the slide. Can you see the slide?
Yes, already, Professor.
Okay, good morning, everyone. Thank you very much for having me today. And first of all, I'd like to thanks to the organization committee members for inviting me as a keynote speaker at this very prestigious conference. And today, the topic that I'm going to give you is about the macroeconomic policies, capital control policies, with the experience from the South Korea. Initially, I was asked to give a speech about the financial technology in emerging market economies, but I decided to switch the topic to this macroprudential measures or capital control policies in emerging market economies, because I believe this has become all the more relevant topic for policymakers and researchers during this COVID-19 pandemic crisis, because because of this COVID-19 pandemic crisis, most of the advanced economies and also emerging market economies are conducting unconventional monetary policies at the unprecedented levels. And as a result, a big chunk of the foreign capitals are flowing into emerging market economies, including Indonesia, South Korea, and many other countries. And now, as the situation normalizes later, then it could become a huge consequences in the end. So in that sense, I believe this is a very important topic to be discussed in today's world. And so I'm going to give you a speech about this paper, which is collaborate with Dr. Young-Ju Kim and Dr. Hyun-Jung Lim at the Bank of Korea. And of course, the views expressed in this paper will be all of ours and should not be attributed to the Bank of Korea. Okay, thank you very much. So, capital flow management measures, or better known as capital controls. This has been one of the most controversial topics in international macroeconomic policies. And traditionally, Western policymakers and government and also mainstream economists, they believed that capital should be allowed to move freely across countries, because that's the way to maximize the global efficiency, global economic efficiency. And the reason is because savings will naturally flow to the most productive investment opportunities. So no capital control should be introduced in any countries. That was the mainstream view on this issue. However, there has been constant resistance the researchers and policymakers from emerging market economies, because the potential cost of financial crisis that incurs from that stems from free capital flows may be too big. And the thing is that when the time is good, the capital flows will be coming into the countries, and that can be good. But in bad times, foreign capitals can leave the country very quickly, and that can actually unstabilize the overall economy. So that is the main concerns. And because of this volatility and vulnerabilities of these foreign capital flows arising from the sudden stops or capital flow reversals. So this kinds of view has been pretty minor in the global scales, but this has become relatively more relevant, and their voices started being heard to the other policymakers and researchers, especially since the global financial crisis and in 2008 and 9, and because during this global financial crisis, the effect has been also very seen in advanced economies as well. So this was no more emerging market economies concerns, but it has become also the advanced economies concerns. And as a result, and also around the time, the good strong economists also came up with strong economic models that can justify the use of capital control policies to minimize the potential cost of financial crisis. So that was the basic background in the last decade. And notably, even the IMF, International Monetary Fund, who used to be the main big proponent of free capital flows, they actually changed their institutional view that in certain circumstances, capital flow management measures can be useful. So they can be justified in some cases. So that has been the huge changes in the policy world. And as for the actual academic evidence about the effectiveness of capital control policies or capital flow management measures, it has been a little bit mixed. And some of the case studies has been conducted in Latin American countries, but there hasn't been any serious and very extensive research on this effect about the effect of capital control policies. And so in this paper, I'm trying to show you some of the evidence based on South Korean experience about the capital flow management policies. And as for some background, many of you from Indonesia and also myself from South Korea, we are very well aware of the East Asian or from East Asian countries. We are very familiar with the Asian financial crisis that occurred in 1997 and 8, right? And during that period, there was a huge currency mismatch and maturity mismatch in many of these countries, Indonesia, Thailand, and South Korea. And that has been a big disaster during that crisis period. And after then, we got some of the lessons from that crisis, and the policymakers and authorities in these countries tried hard to strengthen the macro financial framework of the countries. So they could reduce much of the currency mismatch part. So borrowing in dollars and lending in local currencies, that kind of pattern has been reduced significantly since the Asian financial crisis, but still there has been maturity mismatch remained in the banking sector and financial sectors in South Korea and Indonesia and many other countries. So basically borrowing in short term from abroad and then lending in long term in domestic countries. And that has been also a problem during the global financial crisis, because when crisis happens, then foreign capital flows that inflowed in the countries were leaving the country very rapidly. But because the short-term capital flows can leave very easily, but those banks who borrowed short-term capital flows, they lent in long term. So these banks and lenders in domestic countries were facing liquidity problems. So that has been a major issue during the global financial crisis in these countries as well. And after the global financial crisis, now the advanced economies are starting to conducting the unconventional monetary policies, basically printing money to purchase the government bonds and some other mortgage bonds. And those monies printed in the US and European countries and also in Japan, those monies has nowhere to go. So they started looking abroad, and this money were flowing into many emerging countries, emerging market countries like Malaysia, Indonesia, and South Korea, and many other Latin American countries as well. And that has become a potential issues because of potential spillover effect that can be affected by advanced countries' monetary policy, and it is having some consequences in other countries like emerging market countries. And academic researchers like Helena A. actually pointed out that kind of problems, and now with globalized financially globalized world, now traditional trilemma is becoming dilemma, meaning that even a country with flexible exchange rate regimes like Indonesia or South Korea, they are still losing some controls of monetary policy, because there are so much foreign capital flows coming into the country, which is actually a little bit out of control of the monetary authorities. So Raghuram Rajan, who was the governor of the central bank in India, he actually proposed that the country should introduce some of the capital flow management measures or capital control policies to minimize potential adverse spillover effect from that kind of monetary policy in advanced economies, or the global world should be coordinated, and those monetary policies should be coordinated in such a ways to minimize potential adverse consequences to emerging market economies. So that has been the point these days. And as for the this potential spillover effect, many of you from Indonesia should be familiar with taper tantrum, which occurred in 2013. And the taper tantrum is basically the US Fed chair at that time, the Ben Bernanke, actually mentioned and hinted potential tapering of their quantitative easing policies. They didn't do anything actually, but he just mentioned that there's a possibility of reducing the size of unconventional monetary policies in their country, in the US. And actually the mentioning of that potential event was big enough to shackle the overall economies and global economies and emerging market economies. That was already a big shock to many emerging market economies. And Indonesia was designated as one of fragile 5 countries, and meaning that Indonesia was one of the 5 countries that was most vulnerable to this taper tantrum events. And as you can see here, before the taper tantrum, which occurred in May or June in 2013, there has been a big capital inflows into bond and equity market into Indonesia. Indonesia is in here, and also for other countries. So there's a big positive foreign capital inflows. And then with taper tantrum happening, there is a big negative number, meaning that there has been capital outflows. So they were coming in beforehand, and then afterwards they were leaving the countries massively. So that has been a big shock to these countries. And as a result, the stock market also responded negatively, and it was a big drop in stock market. Currency, Indonesian rupiah, was also depreciating big time during that period, because there was a lot of foreign capital flowing out of the countries. Okay, so that means conventional monetary policies in advanced economies can be really having big adverse effect and spillover effect to emerging market economies. So to defend themselves against this kind of shocks, one of the suggested recommendation was to introducing some capital flow management measures or capital controls. So beforehand, just try to reduce some weaken the incentives of foreign investors to come into the countries. Okay, so trying to reduce some of the volatile foreign capital flows into the countries before things happen. And that was the lessons taken by South Korea. So unlike Indonesia, who still doesn't introduce the capital control policies, South Korea introduced some 3 different types of capital control policies around 2010 and 11 in response to the global financial crisis and unconventional monetary policies. And among 3 of these capital flow management measures, I'm going to focus on one of these measures, which is basically the levy on non-core foreign currency denominated debt, which was introduced in August 2011. So basically, the idea was that government authorities will introduce the tax on banks who borrow foreign currency debt. Okay, so that was the idea. So let me give you a little bit more details about this specific measure. So it is called macroprudential stability levy, and that was imposed on the non-core FX liabilities of the banks. So there are many different types of liabilities for the banks, and non-core liabilities is basically the borrowings from other banks or borrowings from bond issues. But it doesn't include customer deposit. They are called core liabilities. So they didn't impose on customer deposit, but they imposed the tax on this non-core interbank borrowing of this foreign currency debt, okay? When banks borrow from other banks and foreign banks. And they introduced 20 basis points of tax on short-term foreign currency borrowings, meaning that maturity less than 1 year, they were subject to 20 basis points of tax. A little bit lower, 10 basis points or less on long-term foreign currency borrowings, maturity longer than 1 year. Okay, so they differentiated and discriminated short-term and long-term foreign currency borrowings. And here the main idea is that authorities believed that short-term borrowing is more volatile and risky than long-term borrowings, right? As you can imagine, when crisis happens, short-term borrowings and short-term lending can leave the country very quickly as the maturity comes up, right? But if it was lent in long-term, 1 year or 2 years, then the money cannot leave the country very quickly. You should wait until the maturity comes up, right? So in that sense, short-term borrowing can be more volatile and riskier than long-term borrowings. So authorities wanted to switch the overall maturity structure of the banking sector from short-term to longer term. So from less stable to more stable type of borrowing. And that was also consistent with Reinhardt and Rogoff's idea that short-term borrowing is riskier than long-term borrowing. And also the idea of introducing a different tax rate is based on the premise that initially banks used to borrow short-term because they are cheaper. So if tax is introduced in such a way that short-term borrowing is taxed more than long-term borrowing, then probably this relative cost of borrowing short-term to long-term will be switched, and then banks will have weaker incentive to borrow short-term than long-term. Okay, so that was the main idea of this policy scheme. And so the government wanted to switch and lengthen the overall maturity structure of foreign currency borrowing at the banking sector. And there was one important exemption clause, which is that for foreign bank branches operating in South Korea, so this doesn't include subsidiary banks, but it includes the foreign bank branches like JP Morgan, Seoul, or Morgan Stanley Seoul, Goldman Sachs Seoul branches, not subsidiary banks. They were allowed to be exempted for their inter-office long-term borrowing. So if foreign bank branches in Seoul, if they borrowed from their headquarter banks in the US or in Euro area at the longer term, then there will be no tax, okay? And that was because of foreign bank branches were complaining about the policies, and they cannot collect the customer deposit. So their main source of the capital was from borrowing from the headquarter banks, and so they wanted to be exempted. So to summarize, then we can summarize the overall structure of these capital control policies in these ways. So there are domestic banks and foreign bank branches. For their arm's length borrowing, so borrowing from other entities, other banks, there's no difference between domestic banks and foreign bank branches, but it is different across maturities. So if it is short term, then there is a 20 basis point levy. And for medium term, it is 10 basis point, and longer term, 5 or 2 basis point. And for domestic banks, it doesn't matter whether they borrow from third-party banks or other parties or from their branches outside the country. Still, they get the same tax. But for foreign bank branches, if they borrow from related parties, so their headquarter banks, for example, then if they borrow short-term, then they still have to pay 20 basis point tax. However, but for longer-term borrowings from their headquarter banks, then there will be no tax. So this is exemption, okay? And there was a Q&A question and what is the meaning of BPS, and this is a basis point. And probably you may be confused because you have the authority statistic office, right? It is also called BPS, I think. So no, that is not. So this means basis point. Okay, good, very good. So that was the major idea of the policy. And now let me show you some series of the chart about what happened before and after the introduction of these capital control policies in South Korea. And to show you that, I'm going to show you overall maturity structure of the banking sector of the foreign currency account. And to do so, let me clarify some of the accounting concept definitions, okay? So banks have these foreign currency liabilities, and as I explained earlier, there can be core borrowings, which is from a customer deposit, and non-core borrowings, mainly interbank borrowings or bonds issues. And then there's some other operating liabilities, such as trade financing, okay? And then as for this non-core borrowing, which was subject to the tax, it can be either short-term or long-term based on the maturity. And also this short-term non-core borrowing can be decomposed into arm's length short-term or inter-office short-term, depending on whom they borrow from, okay? If they borrow from third parties, it is arm's length. And if they borrow from the headquarter banks, then it is inter-office short-term borrowing, okay? Similarly for long-term borrowings. And then what I'm going to show you from now on is based mostly on the y-axis. It will be FX borrowing ratio. So FX non-core borrowing divided by total FX liabilities. So out of total FX liabilities, what is the share of their non-core borrowing, which is subject to the tax? And also I'm going to show you separately for short-term and long-term non-core borrowings, okay? So this is the chart that shows the FX short-term non-core liabilities in blue solid line and long-term non-core liabilities in red dashed lines, okay? From 2007 to around 2014, okay? And this is the levy introduction, August 2011. And this is the period for another macroprudential policy, which was leverage cap. And basically what I'm trying to highlight here is two things. First, there has been some pre-trend before introduction of these policies, okay? So there has been already decreasing trend in the total share of short-term non-core liabilities in Korean banking sector. So this is aggregate of Korean banks, including domestic banks and foreign bank branches all together. And there has been steady rising trend for long-term non-core liabilities. So basically there has been some of the shift from short-term to long-term even before the policies. But after the introduction of leverage cap policy, there has been no big changes, okay? So I'm going to highlight that this policy wasn't very effective for these maturity structure changes in Korean banking systems. But right around the levy introduction, there has been an even steeper decrease in short-term non-core liabilities and steeper increase in long-term non-core liabilities. Okay, so it looks like at this point, although it is not very accurate, it looks like that this levy policy has been effective in reducing short-term non-core FX liabilities in the Korean banking sector and increasing the long-term non-core liabilities in South Korea. So that is the basic point that can be taken from this chart. And based on this chart, actually, these aggregate patterns, which was publicly available to researchers and other institutions, many researchers actually assessed that the levy policy was effective and helpful, and it was helpful to strengthen the external sector of the Korean banking systems. And for example, IMF also wrote many papers that evaluated that this policy has been effective and it will be useful and also has been successful in increasing financial sector resilience by limiting exposure to liquidity risk, reducing maturity mismatches, and so on. Okay, so based on that aggregate chart, many people thought that this was a useful policy and helpful policy. But we actually casted doubt on the effectiveness of this policy. And the reason is because that we should actually take a closer look at the data, micro level data, rather than just the aggregate data, because we don't know actually what was going on inside each banks. Okay, so we decided to so there are some questions, but let me read that later. Let me continue, and then I get back to the question part back. Okay, so and we casted doubt on it, and we decided to take a closer look into the data, and we actually had got the access to confidential micro level balance sheet of this information, and based on that, we could first of all distinguish what has happened to foreign bank branches and domestic banks. Okay, and so we separated out overall share of non-core short-term FX borrowings, which was actually decreasing in red solid line here, and that was for aggregate, so including both for putting them together, domestic banks and foreign bank branches. And now we separated out. Okay, and this red solid line is foreign bank branches, and blue solid line is domestic banks. And as you can see here, and before the policies, there has been about parallel trend, decreasing trend in short-term non-core FX borrowings in both foreign bank branches and domestic banks. But what is much more interesting is that after the introduction of levy, it was mostly foreign bank branches that experienced the reductions in short-term FX borrowings. And as for the domestic banks, actually there has been very stable and not so much declining trend in short-term FX borrowings. So based on this, we can conclude that this policy appeared to be effective in shortening, lengthening the overall maturity structure of the Korean banking sector, but that pattern was exclusively driven by foreign bank branches. Okay, so that's what we found here. And then the next question will be why? Why that happened only to foreign bank branches and domestic bank branches didn't respond to that policy? Why that would be the case? So that was our next question. And our idea is that there must be something to do with this specific levy structure that had this specific exemption clause only for foreign bank branches. Okay, so if foreign bank branches were allowed to pay no tax on their inter-office long-term borrowing, and also if these foreign bank branches used to borrow short-term borrowings from their headquarter banks, then they may have a big incentive to switch from short-term to long-term borrowings from their headquarters, right? So borrowing from headquarters, that doesn't matter actually whether it is short-term or long-term. It is inside the one big consolidated balance sheet. Okay, they are the same entity. So foreign bank branches in Seoul is just a part of these headquarter banks. Okay, and when they borrow and lend to each other, it doesn't really matter whether they borrow or lend short-term or long-term. So they used to lend and borrow short-term and then roll over periodically. But now, for them, they suddenly got big incentive to switch to long-term. Why? Because if they borrowed short-term, they have to pay tax. But if they just mark it as a long-term in their the balance sheet books, then as for the risk, it doesn't matter, but they can avoid paying tax by just marking 3 months lending as a 1-year lending. Okay, so that could be what they were doing. So we checked out and we further investigated these foreign bank branches FX balance sheet, and we separated out again within foreign bank branches about their third-party arm's length borrowings and inter-office borrowings from headquarter banks. Okay, and this is what we found. So for foreign bank branches, their short-term borrowing from headquarters, which is in red bar here, that has been relatively high before the levy introduction, and then after levy introduction, 2011 August, it has been declining fast. And as for their short-term borrowing from arm's length third-party companies, which was not subject to and which was not eligible for exemption stuff, then this blue bar has been relatively stable before and after. And actually, it used to be very big, and then they were reducing, and then before and after levy, it has been relatively stable. So the point is that this levy policy didn't affect foreign bank branches short-term borrowing from third-party banks, but it affected their short-term borrowings from headquarter banks big time. And most of this reduced short-term borrowing from inter-office, the headquarters, has been switched to this green bar, which is long-term borrowing from headquarter banks. Okay, it was very small before, but now it has become bigger, right? So basically, the short-term inter-office borrowing by foreign bank branches shifted toward long-term borrowing from their headquarter banks. Why? Because that way they can avoid paying tax. Okay, so this tax policy was mostly working through these foreign bank branches inter-office lending channels. Okay, for domestic banks, however, you can see that the effect we already saw earlier that domestic banks, the effect was minimum, and as you can see here, it didn't matter whether they borrow from inter-office or third parties. The thing is that short-term borrowing didn't change much, and for long-term borrowing, it didn't change much at all. Okay, so that policy appeared to be effective in aggregate data that I showed you first, and that is mainly because of these foreign bank branches inter-office lending channels. Okay, and up to now, I showed you all through the illustrative chart. Okay, and I believe that that was already convincing enough and clear enough for you that this policy was effective only for foreign bank branches, but not for domestic banks, and also it was particularly through this interbank office channel, inter-office channels. But I will have to also convince you that econometrically, I can also show you the same thing, okay? So in that sense, I will run the difference in difference regression. And this is the perfect setting for difference because what we are interested in is the effect of levy on before and after the introduction of the levy. So there is the first difference, and whether that effect before and after the levy was different between foreign bank branches and domestic banks. That is the second difference. Okay, so difference in difference will be the ideal methodology in our setting. So I will run a difference in difference specification that looks like this. So dependent variable will be some FX borrowing shares in total FX liabilities, depending on whether we are interested in short-term or inter-office or third parties. And then, and this is bank and month level, so individual bank and monthly level. And then foreign dummy variable is whether a bank is foreign bank branches or not. And this levy variable, dummy variable, is whether the time period is before or after the introduction of levy. Okay, and then there's going to be an interaction between this foreign bank branches dummy and this levy dummy. Okay, and we are interested in the coefficient estimate on these interaction terms, which basically shows us whether there has been effect of the levy in foreign bank branches than domestic bank branches after the introduction of the levy. Okay, good. And this is the baseline regression result. And I can include bank and time fixed effect later or not. And here I didn't include any other additional controls. This is the only the variables that I included. And then dependent variable here is first column is all short-term borrowing shares, and second column is only for inter-office short-term borrowing shares, and third column is for third-party arm's length short-term borrowing shares. And what first column says is that in this interaction term, this is big positive, big negative, and significantly coefficient estimate. That basically says that foreign bank branches reduced the share of short-term foreign currency borrowings by 14 percentage points more than domestic banks. Okay, so after the introduction of this tax policy, foreign bank branches reduced their short-term borrowing much more than domestic banks. And now about the channel, the second column shows that all of this effect has been through these inter-office bank lending channels, borrowing channels. And as we move on to the third column, we can see that that effect was negligible for arm's length, the third-party borrowings. Okay, so all of the effect has been through these inter-office channels. And of course, by the identity, the coefficient estimate from column 2 and column 3, they should sum to the coefficient estimate on column 1. Okay. And now we can also introduce bank and time fixed effect. And by doing so, we will drop and these first two variables, and we will only have these interaction terms, but still we basically get qualitatively similar result that all of this effect has been through the inter-office channels. Okay, very good. And this is just to show you that all the results are robust to additional control variables. Okay. Now, this was based on this discrete definition of levy period before or after a certain time. And after that period, it is all treated the same. And before that time period, it was all treated the same. And that is the typical difference in difference estimator. But we can do further to show you exact timing of the effect. Okay, and that can be done by modifying the our difference in difference estimation strategy by introducing, instead of this post levy dummy, now we can use year month dummy variable, monthly dummy variable. So that way we can see the continuous version of difference estimator. And here the interaction terms, instead of one coefficient estimate that we got from earlier discrete version, now we will have bunch of different coefficient estimate across times. Okay, and the estimation result is summarized and illustrated in here. And before the levy introduction, the coefficient estimate was statistically insignificant. So it all includes the 0 point here. So that there was no effect. So there is no difference between foreign bank branches and domestic banks. But after the levy, now it has started become negative, and they have become statistically significant, meaning that this policy effect has been started showing up immediately after the introduction of the levy. Okay, and if we focus on inter-office short-term lending shares using that as a dependent variable, we get even clearer result that the effect was immediate right after the introduction of the levy. Okay, and that was of course statistically significant. Okay, so I believe this set of the result can convince you some of the summary results from our illustrative method. Okay, so to summarize, so this paper and this study used disaggregate micro level approach to investigate the effectiveness of these capital control policies, and it showed that the aggregate result, the lengthened maturity structure of foreign currency borrowings in the Korean banking sector was driven entirely by foreign bank branches inter-office account. And we believe this is a very important finding because it can give a very different conclusion about the effectiveness of this levy policy. So we agree with many others that yes, because of this, whether it is because of these foreign bank branches or not, in the end, in aggregate, it could lengthen the maturity structures. So it reduced the short-term borrowings and it increased long-term borrowings. If that was the goal, then okay, that's good. But if we start thinking about why that is important, why lengthening the maturity structure is important, then in the beginning, I told you that the main idea was that short-term borrowing is more volatile and riskier, and long-term borrowing is more stable, okay, safer. So the authorities wanted to switch the maturity structure from short-term to long-term to make their overall resilience and stronger and macro stability better. But given that the point that it was mostly through the interbank offices, interbank account by foreign bank branches, then does it really mean that they started borrowing longer term from their headquarters? Does that mean they become more stable? And our answer is probably no, because it doesn't actually matter. And it is meaningless whether they borrow short-term or long-term from their headquarters. Because even though they borrowed long-term, if headquarter banks want their money back from these branches, and if they want to leave the countries, they can easily do so by early repayment, or actually they can ask foreign bank branches to lend to headquarters, okay? So if that is the case, then that doesn't necessarily mean that overall shift of the short-term to long-term maturity structure of the Korean banking sector has become stable, more stable. That doesn't mean so, okay? And moreover, there is a possible unintended consequences and actually they can favor the foreign bank branches and actually give the penalties to domestic banks. The reason is because the foreign bank branches can exploit these arbitrage, regulatory arbitrages. So if they used to borrow short term and then they switched to long term, then now they can avoid paying taxes. So their borrowing cost has reduced relative to domestic banks, who has to pay taxes when they borrow foreign capitals. Okay, so actually foreign bank branches can reduce their marginal cost of lending by that tax amount, which could be avoided by switching from short-term to long-term borrowing from interbank inter-office borrowings. Okay, so overall, what I wanted to highlight today, especially the audiences in Indonesia, is that capital control policy is something that should be seriously considered for the sake of the country's resilience and macroeconomic stability in these times, because there's a flood of foreign capitals coming into the countries right now because of these unconventional and expansionary monetary policies in advanced economies. But later on, soon, this monetary policy will be normalized, and then these foreign monies that came into the country will start leaving the country soon. Then the country may have to face very some tricky times, difficult times because of capital flow reversals. Okay, but that doesn't necessarily mean that you should introduce any capital control policies. And you should be also careful about the designing of the capital control policies. And depending on how you design the capital control policies, actually this can be effective or not effective. Or it can appear to be effective, but in the end, it may not be that effective. Okay, so overall, it is time to rethink the need for capital control policies. And when it comes to the designing of the capital control policies, then you should be also very careful about the specific mechanisms through which the capital control policies will work. Okay, thank you very much. That's pretty much it for my paper presentation. And I now would like to open up the questions from the floors. Okay.
Thank you very much for the comprehensive presentation, Professor Jae Bin Ahn. We've already got 3 questions. The first one is to increase from Naila to Sifa, PNG. To increase public spending, the Indonesian government seeks to increase public spending by providing quantitative easing by the central bank. Do you think such policy can solve the liquidity problem faced by banks during this pandemic time?
Okay, very good question. And this is a very important question in these times as well. And typically, this kind of policy has been cautioned, right? And people were worried about this kind of policies, quantitative easing by the central bank to finance the government spending. And there is kind of monetization, but now advanced economies actually started conducting this kind of policies. That's why they called it unconventional monetary policies. And there has been huge debate actually, but at the lower zero lower bound, now they didn't have many options to do, but that was pretty much limited to these advanced economies that were facing zero interest rate, and that was relatively unseen in emerging market economies. But now with this COVID-19 pandemic crisis, everything has become changed. And now there is a strong voice for this kind of policies for more active role of central bank to finance the government spending. And so in that sense, this question is very timely and relevant question. And this is actually the one that many researchers and academicians and also policymakers are trying to solve. And right now, my take at this point, this is just my personal view. I'm not representing any groups or institutions. So just my own view is that probably this kind of policy should be something that should be saved for later, when actually government faces really hard time in financing and issuing bonds. then may be the time that central bank should step in and do more of these actions. But right now, my understanding is that in Indonesian government, for example, is not having very difficult time in raising the financing from foreign investors, including foreign investors and also domestic investors. So they can still issue government bonds at relatively cheaper rate. So at this point, I don't think this is necessary, and it may actually have potential side effect. So I believe this could be avoided at these times. But of course, if this pandemic crisis stays longer and there is a much bigger problems for government facing in raising the bonds, then that could be considered. But right now, I don't think that is necessary. Thank you.
Thank you for the answer. Moving on to the next question, Professor. It's from Sobri Dirka, PT EMI
Okay.
Persero.
Oh, good. This is also a very good question. I'm not sure she or here, sorry. So the question is about what is about the total capital inflows in South Korea after this policy. So not just the banking sector flows, but overall flows, what happened? And as you could guess, and yes, that effect was mainly to the banking sector because this levy policy was subject to the banking sector. Okay, so that was limited to the banking sector. So it had some effect on banking sector's borrowing, but overall to equity market and bond market, total capital inflows, it had only minimal effect. So it didn't actually have any effect. Okay, so that's an answer. I hope that answered to your question. And yes.
Yeah. And next we have question from Zafri Ananto Husodo. Professor, thank you for your insightful presentation. How would you factor international spillover effect on the risk of sudden reversal in domestic financial market?
So I'm not sure what you meant by factor international spillover effect, but if your question is about whether I consider this international spillover effect is relevant stuff to think about, then my answer will be yes, very much so. And this is exactly the point made by Raghuram Rajan, the former central bank governor in India, and also the Helena Ray in London Business School. So they all point out this importance and critical point of this international spillover effect. And that's exactly what happened in 2013 in Indonesia and in other emerging market economies as well in the event of taper tantrum. So US and European countries and Japan, they all consider only about their domestic market, and they don't have to, in principle, they don't have to think about outside countries. They only care about their own domestic countries. But now the side effect is with this globalized world and global financial systems, their policy has this spillover effect on emerging market countries through these capital flows. And printed money from US will be flowing into emerging market economies. And that's good when it goes into the countries. But when these advanced economies start reducing their unconventional monetary policies, then this money will start leaving the countries. But they came into the countries over time, over 100, over a few quarters or decade or so. But when they leave the country, they can leave abruptly, immediately, at one time, which can be a big shock to the countries. So in that sense, I would say that this is a very important dimension that we should all care about. And also advanced economies, monetary policy authorities, they should also factor in those kind of spillover effect. Okay.
I think for the last question comes from Yosman Bustaman. Mismatch maturity risk created more by foreign banks. Do they create liquidity creation with lower margin and increase the risk?
do they create? This is an excellent question. And in fact, when we check out the balance sheet data, and actually I also showed you some of the detailed information about the liability side for foreign bank branches and domestic banks. Indeed, they tend to show less maturity mismatch than domestic banks. And the reason is because both foreign bank branches and domestic banks used to borrow short-term mostly, but domestic banks actually lend to many of these industries and corporate in long terms. So there was a rising, rise in this rising maturity mismatches. But for foreign bank branches, their operation was mostly in foreign currency derivative market or more short-term lending. So they borrow short-term and lend to short-term or operated in short-term ways. So in that sense, the maturity mismatch was a little bit smaller in foreign bank branches. Okay, so that's the thing. And that was for Korea. Of course, for other countries and for Indonesia, I'm not so sure about their operations, but I believe the foreign bank branches are also very active in Indonesia, and they are the big source of this dollar liquidities. So that is something that could be potentially interesting topic for Indonesia. Yeah, good.
Okay, thank you very much for your answers, Professor. So we have closed the Q&A session. Once again, thank you very much, Hamzamida, Professor Jae Bin Ahn, our distinguished speaker. And ladies and gentlemen, that is the end of our first session. Conference participants can now switch to the parallel session waiting room as the session is about to begin in 10 minutes. And here's the rundown for the rest of the day and tomorrow's schedule.
Thank you very much. Bye-bye.
Thank you very much, Professor Jae Bin Ahn, once again.